Welcome to another edition of Strategic Financial Management. In today's class, we shall look at the money cost of capital. We have examined the real cost of real cash flow and money cash flow in our previous class. In today's class, we shall look at the money cost of capital, which we have actually explained that in our previous lecture, as well as the real cost of what? Capital. I said the money cost of capital is like the actual costs in a transaction that is the nominal that is in nominal term. They are inflated cash flows. So what it means is that your money cost of capital has element of inflation. Another name for money cost of capital is the nominal terms, right? And I said that money cost of capital will goes with money cash flow. Even in a question, they tell you that, oh, the cost of capital is real. Now, what it means is real, which is the current term. What it means is that the cash flow now, they now give you that, oh, the cash flow is, there is an inflation in the cash flow. Probably the cash flow is nominal cash flow. You can see that you are given the nominal cash flow, but a real cost of capital. No, now you need to convert the real cost of capital to money cost of capital because money cost of capital will goes with the money cash flow. So how will you convert your money cost of capital is to say money cost of capital equals to 1 plus RCC, which is the real cost of capital, 1 plus I, which is inflation rate, minus 1. We give you the what? The money cost of capital that you will use to discount the project. Now, the same thing applicable to the cash flow given to you may be stated that, oh, the cash flow is in real term, which means the current term, right? Which does not include inflation. Now, what it means is that, and you may be given what is it called? Money cost of capital. Now, when you are given the money cost of capital, the next thing for you is to convert that money cost of capital to real cost of capital because your cash flow is in real term, right? Your cash flow is in what? Is in real term. And for you to convert your cash flow to for you to convert your real cost of capital money cost of capital to real cost of capital, you have to use this formula, which is the real cost of capital equals to 1 plus MCC divided by 1 plus I, or which is F, which is the inflation rate given to you in the question that, oh, the inflation rate is 5%. Class, please, in another ways, you can as well convert when you are given the money cash flow and the real cost of capital is given to you in the question. You cannot use the real to discount money cash flow. You can still convert the money cash flow to real cash flow, but why do you want to stress yourself, give yourself unnecessary headache, and you keep wasting time? Why can't you convert the real to money cost of capital and you move on? You use it to discount your project and you move on, class. Now, having explained this, we will move on to the rule in solving inflation questions. Class, pay attention. Use money cost of capital, like what I've actually explained now, to discount money cash flows, and real cost of capital to discount real cash flows. Identify the nature of cash flow, that is what? That is, let the cash flow indicate the cost of capital to be what? To be used. Of course, Definitely they will tell us the cost of capital we are to use to discount the project. Class. If the company is diversifying, you already know that you will use the appropriate cost of capital to discount the project. Now, when you want to use the appropriate cost of capital to discount the project, and they tell you that this project, this cash flow is a real cash flow, and the appropriate cost of capital that you calculated is in money cash flow, and your cash flow is in money cost of capital, and your cash flow is the real cost of capital, is the real cash flow. After you calculate your appropriate cost of capital, you need to convert it to the money cost of capital so that you will use the money cost of capital to discount the what? The money cash flow. Class. Real cash flows are those exposed in year zero price, constant price, the current terms, right? The current terms, it will be stated in the question. Where the examiner is silent as regards the cash flow or cost of capital, it is assumed to be what? To be in money terms. Take note. Where several items attract different rate of inflation at different times, and the cash flow will be what? Will be needed. Will be needed at a future date, convert them to money cash flow and discount with money discount rate. They are telling us that when you are given different times inflation rate, don't forget when you are given more than one inflation rate, right? It becomes a specific inflation, right? We are not, I'm just letting you know, right? So a future, they convert them to money cash flow and discount with what? With the money discount rate. Lastly, any item stated in year one, prices attract no inflation in year one. That is, inflation becomes applicable from year two upward. Of course, when you want to inflate, it will be from year two because what you have in year one is 20 naira. So what will be the future value? What will be the present value of, let's say the project is for 4 years? You have to start from year two because the current price is 20 naira. When you want to inflate, you start from year two, unless if it is stated that, oh, the inflation rate for year one is this 2%, in year two is this 2%, and that is how you will approach that question. Please take note of this part as it is very important. Now, another thing you need to know, why I'm taking my time to explain all this, because I don't want in a situation whereby we will now want to solve questions, then you start asking that, oh, how did you get this? Oh, why is it like this? Oh, no, 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 no. So you just have to have an understanding of how it works before we go into deep calculation. Now, taxation. What is the effect of tax in capital what? In capital investments? Class. Don't forget that you pay tax on that particular investment. If you make a net cash flow, you pay tax, right? Now, there is what we call depreciation. Let me start from the taxation. Taxation is considered in capital budgeting because of its importance on the cash flow. All cash inflow associated with the project, such as income, revenue, give tax payment. Of course, you will pay tax when you want to embark on a capital investment project. You will pay tax at the end of the period, right? Now, such as lease, rental, capital allowance, there is no tax implication on working capital. No. Why? Because I've explained this in our previous lecture that working capital is what you use to run the business. At the beginning of the year, it becomes year zero. At the end of the year, you recoup back your investment. Right? Now, depreciation is not allowable. For tax purpose, it is not allowed because of the lack of uniformity And that is what bring about capital allowance. Now, in every question, you'll be told that depreciation is not allowable, but there is capital allowance of this. So when depreciation is not allowable, definitely there will be a capital allowance. Or depreciation is allowable for tax. So when they say depreciation is allowable for tax, they are making reference to capital allowance. We will get there. Capital allowance is a relief granted in lieu of depreciation, right? Instead of depreciation, you say it is capital allowance. Now, capital allowance could be you may have balancing allowance or balancing charge. Class, what is balancing allowance? Balancing allowance is the relief granted for loss on disposal of assets, right? When you make a loss, Chimobi bought an asset for 50 naira and sold the asset for 10 naira. Chimobi automatically make a loss of 40 naira, and that is what we call balancing allowance. Now, the relevant tax authority will grant you a tax savings on that capital allowance because you make a loss in that what particular investment. That is what bring about tax savings under the what? Under the capital budget. Let me repeat this again. Chimobi bought an asset for 50 naira and sold the asset for 10 naira. The difference is what? The difference is 40 naira loss. The relevant tax authority will grant you what? An allowance, a tax relief on that. That is what we call tax savings, right? That is what we call what? Tax savings on that what? Investments. They will give you an allowance. That is why they say it's the relief granted for loss. Why balancing charge is when you make a profit, you make a gain in disposal. Let me not use profit because gain or disposal of assets, right? You make a gain on disposal of an asset. You bought an asset for 50 naira, you sold it for 100 naira, you make 50 naira what? Your profit. What does that indicate? It indicates balancing what? Charge. Now, what is this balancing charge? Attract tax payment since it is a gain on what? On disposal. When you make a gain on disposal of an asset, you have to charge tax. It attracts tax. But when you make a loss, you have what? That is, you have balancing allowance. And the relevant tax authority will charge you, will give you a relief on that what? Allowance. Class. Instead of charging depreciation, you charge capital allowance. Now, on this capital allowance, the relevant tax authority will grant you a tax savings on that allowance because you are using an asset for the business. Now, what bring about balancing allowance and balancing charge is when you want to dispose an asset, right? It is when you want to dispose an asset, right? Now, for instance, now Chimobi bought an asset for 50 naira, and at the end of the year, you sold the asset for 20 naira or 100 naira. You already make a profit of 50 naira. That year that you make that profit, that is balancing charge. You will not charge capital allowance at the end of that year because the year of disposal, it is the year of disposal of an asset. Class. When you dispose an asset, in that particular year, you are not entitled to capital allowance. It is common sense. You've been charging a capital allowance for the last 5 years and you dispose that asset. So why do you want to charge capital? You've already disposed. Why do you want to enjoy capital allowance on an asset you dispose? So that year, class, that year that you dispose that particular asset, you will not charge capital allowance on that particular asset. We will get there, class. Now, another thing you need to know is the steps on solving, finally, steps solving what? Taxation issues in in capital budget class. When you want to solve taxation, compute your capital allowance, compute the tax payable or claimable using the annual cash flow, exclude initial outlay, describe value, or working capital. Class, most students make a lot of mistakes when they want to charge tax. They will charge tax. Some will charge tax on the cost of the investment, describe value, and the working capital. Why? You want to embark on a budget, you have 15 naira. Why will you charge? It is a cost. Why do you want to tax it? Scrap value means terminal value, sales proceed. Class, you already charge the company. Why do you want to charge what you dispose? The scrap value. Why? Because already the company itself is entitled, is going to pay tax at the end of the period. So definitely the scrap value itself will be inclusive. So why do you want to tax it again? The working capital, what you use in running the business, at the beginning of the year, I can diet is for 4 months, right? And I use 100,000 to start in January, right? At the end of the 40 months, I will tell my people, please, my 100,000 naira. Is that also my 100,000 naira? I will go cook it back from the what? From the investment, right? Compute the net present value using the original question, incorporating the tax effect as calculated above. We will look at all these things. So these are the things you need to know under the what? Under the capital budget. Before we move to capital rationing, divisible project and all that, or sensitivity analysis, right? I think we're supposed to treat sensitivity analysis. It's not that I can't even give you, I didn't even have anything on it, but I can actually explain to you, right? That you will understand what is sensitivity analysis. If you are doing a, what is it called? Uh, some of you here are portfolio managers, investment analysts, financial analysts, stock market this and that. You will understand that when they talk about sensitivity analysis, it's talking about the changes in a certain variables, right? What will be the, see, if what will be the, what will be the changes if your rent per annum increases? What will be the implication to you? What will be the implication? That is what it means. What will be the implication? You want to embark on a project and you have to pay a rent. What will be, what is the sensitivity analysis of that rent in that project? Now, what it means is that how many percentage will the rent occupy in the what? In the investment. So when the percentage increases, rent is the cost. When it increases, what is the implication on the investment? The implication is that the cash flow will reduce, is that also? And the NPV may likely becomes what? Negative. We will get to that point. So you can see it is, you have to just understand these terms, right? Sensitivity what? Analysis. We will actually get there. Now, I have a question for you before we go. Before we look at this practical illustration, these questions on the capital budgeting. Do we have anyone that have question? If you have question, unmute your mic and ask before we continue. Quickly. Question. If you have question, unmute your mic and ask before we continue. So if there is no question, we have to continue our lecture, right? Okay.
Good evening,
Now,
sir.
okay, Rachel, long time.
Yes, sir. Good
Happy
evening,
New
sir.
Year.
You should do best, sir. Thank you,
Okay.
sir. Thank you for the explanation, sir. But I have one question as regards how can we relate sensitivity analysis with capital budgeting?
How?
How can we relate sensitivity analysis with capital budgeting?
Question. In fact, you're supposed to have special gifts, but you don't collect my gifts. So interesting. I love that. Right? Why is like that is because I made I state an illustration that when you have a positive MPV, it means that, oh, you will say no Martin, you say, oh, the project is viable. If you think that the project is viable, I will look at you like maybe you are still in skills level, you've not upgraded. You can't just tell me that the project is what? Is viable. What is the implication to the investors? When a project has a positive MPV, it indicates that you have maximized shareholders' wealth, right? You have maximized the shareholders' wealth. Class. Now, the sensitivity analysis I'm talking about is the changes in a variables. Now, if you want to embark on a project and you need to rent an apartment for your casual labor, now, if the rent is 50 naira, right? The rent is 50 naira. What would be the percentage of that 50 naira, the present value of it, in how many percent will that rent take from the positive MPV? That is why they said the sensitivity analysis of rent is equals to MPV divided by the present value of the rent. Maybe the rent, you have to pay rent from year 1 to year 4. What will be the present value of that particular rent? Net present value divided by the present value of the rent will give you this. If the sensitivity analysis is 50%, what it means is that the rent should not increase more than 50%. Immediately it increases more than 50%, your NPV becomes what? Negative. And when your NPV becomes negative, what is the implication? You are not maximizing what? So that is the reason why you have to create a sensitivity analysis scenario, right? You have to create it that, oh, what if it increases like this? What will be the effect? Oh, it means that the rent should not increase more than this, right? When the finance manager now said, oh, we need to increase the rent of our casual labor, you will not show them, this is my sensitivity analysis. My sensitivity analysis is showing that if this cost should increase more than this project will not be viable. And if it is not viable, we are not maximizing the shareholders' wealth, right? And there is no essence of us embarking on this project. And that is why it is very important for you to do a sensitivity analysis on a what? On a capital what? Investment. Rachel, are you with me?
Yes, sir.
Do you get that? Good question. You can see, right? You can see. SFM is practicable. If you understand it, you are good, right? You are good. Well done. Well done. That's a very good question. Now, I have an illustration here, right? Questions on capital budget. I think I have up to 6 questions. I think currently I just have like two like that. I have like 6 questions class. Out of these 6 questions, we will solve at least four. The remaining two, that's it. If you like, solve it, or if you like, don't solve it. But that's four or three. I think 3 or 4 will do that because we need to move to bond valuation, right? You can see the way we treat all these topic one after the other. That is how it is. The knowledge of 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 risk adjusted cost of capital is very important before you treat capital budget. Some people don't know how to teach. You don't know. You can't just imagine me now. I'm in a SFM class for the first time, and you are introducing bond valuation to me. Like seriously, there is nothing you want to say in that class that we understand. Do you know why? Because you leave the main part, introduction, the cost of capital, the appropriate cost of capital, you move to valuation without capital budget. So where are the function of the financial manager, please? Where are the function? So that is why at Next Gen Professional Associate, we teach you step by step. Oh, this is what you need to know before this, right? From this part, we move to bond valuation, from bond valuation to portfolio theory, and we will use 1 month for valuation of a business. You will love it, right? Because we will do a practical illustration of valuation of a business. Your economic value added is a method of valuation. The shareholder analysis is a method of valuation. Merger and acquisition is a method of valuation. Free cash flow to the firm or to equity is a method of valuation. Class, you will enjoy it, right? We will get there. Now, first off, questions on core capital budget, right? Last Chance PLC is a manufacturing, 15%, okay. Is a manufacturer of mobile communications. It is about to launch a new communications device, right? It is about to launch a new communication device. Please confirm if you can see my screen. If you can see my screen, confirm if you can see it. Can you see my
Yes,
screen?
we can see the screen. Yes,
Okay, okay,
yes.
okay, that's fine. Okay, that's fine. That's fine. Thank you. Now, it is about to launch a new communication device, Nucleo, right? Which its directors believe is both more technological advanced and easier to use than devices currently offered by its rivals. The Nucleo will require a major investment in facilities, and the directors believe this can take place very quickly. Very what? Very quickly. And production be be started almost will start will be started what almost immediately. LCP expects to sales. Don't forget that they want to embark on a project, capital investment. LCP expect to sell 132,500 units of Nucleo in the first year. That is why if you are a financial analyst or an investment analyst, when your company want to embark on a project, you speak with your project director, your project managers, and all that. You guys will come together and make some projection that are realistic. And in your projection, right, it should include some macroeconomic factor. That is why you will take consideration of inflation, because it is what it is very important, right? Now, in its first year, the unit is 132,500. Sales volume is expected to increase by 20%. Sales volume is expected to increase by 20%. The sales volume will increase in year 2 and 30% in year 3, and then be the same in year 4 as year 3, which means that when it increased by 20% in year 2 and 30% in year 3, and then it will now remain the same in year 4 as year 3. You can see the English, which means that the 30% in year 3 will still be the same thing as 30% in year 4. Now, as the product reach the end of its useful life, the initial selling price in year 1, that is the selling price, is expected to be 100 naira per unit before increasing the rate of inflation annually, which means that in year 1 it will be 100 naira per unit. You can see there's no inflation there. 100 naira per unit before increasing the rate of inflation. We will now look at the rate of inflation, right, as we move. Now, the variable cost of each the variable cost of each is expected to be 43 naira 68 kobo in year one, the variable cost in year one, right? Rising by a rate of inflation in the subsequent years annually. The rate of inflation, they've mentioned it twice now. They've mentioned it in the selling price. They've mentioned it in the variable cost that after year one, this thing will increase by the rate of inflation. So you have to take note of that. But what is the rate of inflation? We don't know yet. Fixed costs are expected to be 900 in year one, rising by the rate of inflation in this what? In the subsequent years annually. Now, the initial investment in non-current assets, right, is expected to be 16 million, which is the cost when you want to embark on this project. The non-current asset, the costs of the asset is 16 million, which will be at your year zero. LCP will also need to make an immediate investment of 1,025,000 in working capital. Of course, it will be part of your year zero. Your working capital is what you will use to run the business. You see this 1,025,000, it will be on year zero. At the end of the year, you will recoup your money back, right? You will take it back. It becomes your what? Your inflow. The working capital will be increased annually at the rate of each of year 2 to 4 by the reinflation rate, and is fully recoverable at the end of the project life. You can see. Now, this question is even simple. Some question will tell you that the working capital will increase as the rate of selling price or at the rate of sales. Right? We will get there. We'll solve another question like that. LCP will also incur one-off marketing expenditure. One-off. The question is this marketing expenditure, is it a relevant cost? I need someone to omit his or mine to explain that, is this marketing expenditure, is it a relevant cost or irrelevant cost? Someone should do that for me, please. Please omit your mic. Omit your mic. Is the marketing expenditure a relevant cost or irrelevant cost for the project? If it is relevant cost, why? If it is not relevant, why? Hello? Post-inflation, after the launch of Nucleo, the marketing expenditure can be assumed to be made at the end of the year one and be tax allowable expenses, right? It is a one-off because that is what they will use to market the project. So it is a relevant cost. LCP pays company tax on profits at annual rates. At annual rates of 25%. You can see they pay a profit of 25%. Tax is payable in the year that the tax liability arises. We are even lucky. Sometimes tax will be paid in arrears. Year one will be paid in year 2. Year 2 will be paid in year 3. But this will be paid in the year in which the profit is realized. Tax allowable depreciation is available at 20% on the investment in non-current assets on a reducing balance basis. Plus, in some question that is so wicked, the non-current asset given to you as 60 million may be inclusive of working capital. Now, they will now give you 20% to reduce the non-current asset. Don't forget, the working capital is inclusive in the non-current asset. Right? If you are smart enough, you quickly remove the portion of working capital and charge the 20% on the asset, because you can't reduce the working capital. You can't charge depreciation in the working capital. We will get there. A balancing adjustment will be available in year 4. The realizable value of the investment at At the end of the year 4 is expected to be what? 0, which means that we did not see any gain from this what? From the asset, which becomes what? 0. Now, the expected annual rates of inflation in the country in which FCP is located is 4% in year 1, 5% in year 2 to year 4. You can see the inflation rate that they've mentioned in the variable cost. They say variable cost will be based on the annual inflation rate. Don't forget that, okay, based on the annual inflation rate. And this is the annual inflation rate that they are talking about here, right? Now, don't forget that. Let me come back to the marketing expenditure. It is post-inflation, which means that they've considered inflation on that, right? That is why they did not say it will increase, right? They say it is one-off. And the capital expenditure can be assumed to in just 1 year at the beginning of this project that want to launch it. You do your marketing, and after that, come after the more, let everybody go. Is that not so? Right? Now, the last paragraph, yeah, the last one here says that the applicable cost of capital for this investment appraiser is 11%. We are even lucky that they even tell us that the applicable is just 11%. So which means that you use 11%. So they didn't tell you that, oh, the cost of capital is zero. The cost of capital is money, is this, so that you can do conversion, right? So the lastly is evaluate the financial viability of this what? Of the project. You can see how simple it is. Is it not simple, class? From the analysis, is this question not simple? This question is simple now, right? This question is just adopted from one of the ACCA um, questions like that, right? So it's very simple. So let's just do it. What's this? Incoming? Okay. Last chance. Quickly, suggested solution. Please don't forget presentation matters, right? Suggested solution. Some of you that are smart enough, I know, you would have screenshot this question. Should in case we did not finish this, you will complete it, right? So, last chance. Last chance. That is the name of the company, right? Last chance. Okay. So, evaluation of financial, okay, viability of the projects, right? Evaluation of financial viability of the projects, right? So, what is it now? Okay, now, how many years first? Before you do this, let's do our workings, right? Let's do our workings. I will teach you the shortcuts so that we can move ahead, right? Let's do our workings. Now, don't forget that you do your sales. They made mention of variable cost here. Is that not so? And there is sales here. There is sales selling price here. Is that not so? And they made mention of variable costs. Is that not so? There is fixed cost. Sales minus variable costs. Minus fixed costs. Is that not so? Minus fixed costs. Which other costs do we have? Which other costs do we have? Marketing expenses. You have your profits. Is that not so? You have your what? You have your profits. Even before that, your profits, don't forget that you will have tax savings on capital allowance. You will have what is it called? Tax savings on what? On capital allowance. So, class, let's quickly do the sales. How many percent do we? How many this thing do we have? Okay, 15%. Okay, 15 minutes. Okay, I thought I created something that would be more than this, but it's fine. Okay. Now, class, are you tired? So that we are not even saying anything. Are you tired? Okay. Now, let's this side should be our workings. Let's do our workings first. Let's just bring our workings here. Okay. Please, when it is 10 minutes, this call will end in 15 minutes out. So when it is 5 minutes, let me know, please. Okay, quickly. Sales volume. Sales volume, right? Sales volume. So what happened to sales volume? Sales volume is expected to increase by 20% in the first year, right? In year 2, and 30% in year 3. Please screenshot this. And 20% in year 2 to increase by 20% in year 2. Is that not so? Okay, good. So which means that year one, what is the sales volume? 132,000 units, right? Is that not so? Class, what is the sales volume? Class, what is the sales volume?
One
Oh?
thirty-two 500.
Okay,
132 500.
Thank you. 132,500 units. That will be your year one. It will not change. Then year 2, right? Year 2, we're told that it will increase by how many percent? Please screenshot this part, right? By 20% and 30% in year 3, right? 20%, 20%. Please increase this by 20%. What do you have? 1, 2 units times 20%. That is what you say?
159,000.
What do we have?
159,000.
Okay, 159,000 units, right? So in year 3, and it will increase by how many percent? 30%, right?
Yeah.
30%, is that not so?
Yes.
Okay, 30%. So what will increase by 30%?
159
159 units
times 1.2
times 1.3. What do you have?
700.
203
6
206 700. Then year 4 will still be the same with year 3. So this is 206 700 units times 1.3. What do you have?
268 710.
268 710 units. Okay. 268 what?
710.
units. Okay, that's fine. Okay. So if this is established, let's check. What is the sales? What did they talk about sales? The sales will do what? The selling price in year 1 is expected to be 10 naira per unit. Is that not so? Before increasing rate of inflation annually. Is that not so? 100 naira per unit. So what is the inflation rate annually? This is the inflation rate annually, 4%, 5%, right? Right? So don't forget that the selling price is year 1 is 100 naira per unit, right? So selling price selling price year 1 is 100 naira per unit. It's 100 naira per unit, which is year 1, right? So year 2, and what is the inflation rate? You can see in year 1 is 4%, right? While in 5% in year 2 to 4. So it will increase by 5% in year 2 to what? In year 2 to 4 per unit times how many percent?
0.04.
4%.
Okay, what is the inflation rate?
4% in year 1.
No, in year 1. No, you will not. It will not apply to year 1. Will it apply to year 1? I say, okay, where is the selling price? Where is the selling price here? Okay, the selling price in year 1 is expected to be 100 naira per unit, right? Before increasing, before it will now increase the rate of inflation. So it means that after the year 1, that is when it will start to what? To increase, right? And it is what? Please, we need to understand that. And it is by what? 5%. 5%. Is that not so?
Yeah.
Now, if you want to increase this by 5%, let's say by 5%, you have 1.5.
Hmm?
Is it 1.5?
No.
Increase it by
0.05.
1.05.
okay, thank you, 1.05 points incoming 0.05, right? So what do we have?
105.
105 per unit. Year 2, what do you have? Year 3, rather, 100 naira per unit times 1.05. So what do we have? Year 4. Please, what do we have? Year 3.
I didn't get. Are we still doing 100 naira per unit in year 3 or 105?
Okay. What do you get? What do you have in year 2? Sorry. What do you have in year 2?
105.
105. Okay. Thank you. 105. What do you have?
110 naira 25 kobo.
110,
25 kobo.
25 kobo. So next is 110.20 per unit times 1.05. What do you have?
115 naira 76 kobo.
115 naira, 115 naira, 17 kobo, right? Now, this is, oh, wow. Now, this is the selling price, right? Now, these are the selling price as well as what? The sales volume. Now, can we calculate?
0.76.
Okay. What do you say? You're saying something.
It's 76.
I can't hear you.
It is
Okay.
115 kobo.
115.
76 kobo. Not
Okay,
17.
Okay, 76. Thank you. Okay, now the sales. Now you will not get your sales.
So we have 5 minutes more.
Oh, wow, interesting. Oh, 5 minutes. Okay. Okay.